First Gen Wealth, we talk about an entrepreneur's journey to creating wealth. I've got a lot of friends, a lot of colleagues, a lot of peers that they're brought up with money and the ability to handle and figure that out. Finding dollars has always been easy. Finding a deal, making money, I can do that. What to do with it to make it continue to earn so we do have that generational wealth, that's the missing piece. We want our money that we've earned through blood, sweat, and tears to now go to work for us so that money is making money while we're sleeping. All right, hello and welcome to First Gen Wealth. I'm your co-host, Randy Woodworth. I'm here with my brother, Jim Woodworth, who's going to sit in this entire season. This is episode 3 of season 2. And today, we're finally going to talk about a topic my brother's been hounding me about, important stuff that we think you guys should know, and that is the self-directed IRA. So I know you brought notes last week because you planned on taking that or talking about it, and I railroaded the conversation in a different direction. So I apologize for that, but
I'm note free this week, so just going off memory and what I've done. So
this is highly unusual that we're going to fly from the seat of our pants here.
Yeah, right. Yeah,
that's
the one time I was prepared, and
yeah, and then I sidetracked it.
That's all right.
I will. So I'll let you open it up, Jim, and just talk about the self-directed IRA, and then I'm sure I'm going to have some questions as it comes. Do you want to throw a disclaimer out here,
yeah,
right?
For sure. So I've done this, I do it, but by all means, you should consult with your tax professional, your accountant, whoever it may be. Just because I would hate for me to tell you something and you go off and do it, and then that creates some kind of huge tax liability for you. So do your own research.
So we're going to talk about our experience with it, and definitely, like Jim said, consult your team, whether that's your CPA, your accountant, your legal team, your attorney, your grandmother, whatever it needs to be.
Or me. I can try to offer some guidance too.
Yeah, but we're not necessarily field experts here. We know it's a tool. We use it. People that we've invested with, that invested with us, have used it, and we'll just talk about our experiences with it. So definitely a good tool. So go ahead, bro, and break it down, and then we'll kind of take it from there.
Sure. Yep. So I started using a self-directed IRA about 3 years ago, and it was a tool for me. I left the corporate world. I was at a company for about 14 years and had a sizable 401k when I left. And the typical one of two things you can do is either A, just leave it where it was, so mine was with Fidelity, or most people just do some type of 401k rollover because whoever their financial advisor is wants to get their hands on that money and add it to their portfolio at whatever institution they're at. So the third, very little used option would be to roll it over into a self-directed IRA. So I work with a custodian out of Ohio, Equity Trust. And it's basically just a placehold for my money, and then I can choose whatever investments I want to invest, wherever I want to invest my money, with the exception of life insurance policies and collectibles.
Okay, so that's where the term self-directed comes from. So you took your 401k from your former job,
Rocket Mortgage,
and rolled it into a custodian account. But you direct it, self-directed. You direct and you tell that money where to go and where you want to invest.
Yep.
Correct?
So typical IRA or 401k, you have mutual fund options. You have stocks, bonds, whatever the typical financial assets that you can invest in. With a self-directed IRA, you can invest in gold, silver, businesses, real estate, cryptocurrency. You really have a huge variety of options that you typically wouldn't otherwise have. And I still have the ability to invest in mutual funds and stocks and bonds and whatever else, ETFs,
sure,
if I choose to do so. But where I've had a lot of fun and success is investing in real estate or loaning people money for various reasons.
Sure.
But I've also invested in other real estate partnerships. So some different things you can do with that, and we can get into some specific details.
So talk about the advantage where you've invested in a real estate deal. Now, typically, let's say whatever it is. But at the end of the day, you're getting some rent, right? So does that rent go to your checking account? Does that go in your pocket? Like, how does that get handled?
Yeah. So it's self-directed, but I don't have any control over my money. So the money comes in, I can't cash it, I can't spend it. It goes back to my IRA. So it'd be similar to, you've got stocks in your 401k that pay dividends. It goes back into your 401k.
Can't touch that either.
Can't touch it either. So every time I get a rent check, or in scenarios where I've flipped a house, fixed it up, resold it, made a profit, all of that money goes back to the IRA. The other thing I can't do, I can't manage it. So
that's why you've got the custodian account.
Correct. So in the sense that I'm like, when I flip a house, I wasn't there ripping the carpet out or peeling the paint or, scraping the paint or painting it.
So it has to be a situation where you're a fully passive investor.
Correct. Okay. Yep. So that's a downside, I guess, but
there's no difference. It's not like you can invest in Coca-Cola in your mutual fund and then go tell Coca-Cola what to do.
Correct.
For your dividend.
Correct. But, if some people like to, could I be more profitable if I was there doing some of the work myself, perhaps?
Well, that's what your income's for. And that's, so we're talking about a situation where you may have been diligent about saving over the course of the last 10, 15, 20 years or 5 years or whatever, or looking to do that, right? And you want to be a little bit more control of your investment while still benefiting from the tax advantages of an IRA, a 401k. So all we're saying is here's an alternative.
Yeah.
You can't control what the board of InBev or Coca-Cola or Google does. You can invest in them. You can get the dividends. Well, with some of those companies, not Google, but you can get the dividends and you don't have any control and you don't get the cash or out of your dividends anyway. So it's really no different from that perspective. It's just another tool where you may be able to have a lot more insight on your investment.
A lot more insight. And to me, I feel like it's a lot less risk because I am in control. I get to pick the asset. I get to pick the real estate. If things go south with it, it's 100% on me. Where if I own a stock in Coke or whoever,
you have no control.
I have zero control over what what their board decides or whatever. If the stock market plunges, I'm protected from that.
Yeah.
And so I get to choose what deal I like. I've done enough of these to where I have a really good idea if things go wrong, what it's going to look like. And if I for example, if I want to flip a property, and then in 2008, 2009, a lot of people flip, and then they got caught with all these properties. Well, they didn't have the cash flow to where they could just rent it out. You know what I mean?
Right.
So a lot of them had to let them go. Where it's owned by my IRA, it doesn't really matter. I can now collect that rent and I can hold it longer because there's not debt associated with it. Or if there is, it's you have such a small loan to value, or you know what I mean? You're not in debt.
Right. And you weren't living on that.
And I wasn't living. I can't live on it. Right. So you can make, I think, better decisions knowing that, okay, if worse comes to worse, this is a long-term decision. I'm 43. I can't touch it for 17 years anyway.
Right.
So now I have more flexibility, and I think just you can make a lot better decisions for much better returns when you have that type of mindset, knowing that I'm not trying to just make a quick buck.
Right. Right. So, and with, we had a gentleman that used a self-directed tool to get involved in a big project with us. He invested in a real estate deal. That deal has its own LLC. He actually didn't become a partner. He lent that LLC money. So he just did a loan. We had an established interest rate. And then that company sends a check to his custodian,
custodian
every month in the name of FBO, whatever his,
for benefit of James
for the benefit of.
IRA.
So he's got a piece of the pie for the equity side, right? And he's getting a monthly distribution at a rate that he felt was extremely competitive with what he thought he could get in a mutual fund. So he's kind of getting the best of both worlds. And it's like something he's not going to be able to touch anyway, but he's seeing significant, amount of money in the form of interest disbursements going in his checking account or his 401k every month.
Yeah.
And it's growing, and it's just a way he's like, why would I get into something? This is cool. I can affect here locally. It's an investment I can go touch, feel, see, right?
Yeah, well,
you
for
can
me-
make
yeah,
you
for
can
me-
make an impact locally with doing stuff like that.
For sure, make an impact. And for me, like it really, like it fuels the creative side of me because I can, by trade, I'm a mortgage loan officer. I own a mortgage company. And sometimes deals don't fit into like that box of traditional financing. So I can help people with my IRA, whether it's through loaning the money, doing some debt consolidation, doing some different things through my IRA that you typically wouldn't be able to do otherwise through your normal banking means. So it always allows it to me. I think the most fun is you can get super creative with what you do and what you invest in. And it also gives me the opportunity to do things I otherwise wouldn't be able to do. So, for example, if I've got enough cash in my IRA that otherwise I wouldn't be able to touch, I couldn't go out and buy X property because I don't have the cash, and maybe you can't get the financing for it because it's not in the right condition. So I can use that tool to do things I otherwise wouldn't be able to do too.
And then all of that equity, all of that rent, all of those proceeds, like even on a flip property, like you said, there's usually a pretty significant capital gain
gains,
event. That all goes right back into your IRA, but it's
tax-free or tax deferred. The majority
depending
of
on your setup.
The majority of my IRA is in a Roth.
So it's tax free.
So it'll be tax free in 16 years when I have access to it. But that's a nice thing to think about when.
So not only are you making 10, 15, 20% on this property, you're saving another 25, 30% from a tax consequence.
Yeah, 100%.
So huge tool to be able to get involved in the real estate world without maybe dipping into your living situation as far as that goes. Maybe you've got a company match program. You're a guy that works at a shop or whatever, and you've been contributing to a 401k. You've got a company match. It's just sitting there. It's been there for a long, long time, and you really don't have any control over it. Well, here's a way. Boom. Now
you have to leave that company.
Yeah, you would have to leave.
So you have to.
Right.
Yep. So if I'm working for X and I'm still actively contributing that 401k, you would not be able to
that would not
put
be
that
qualified.
into a self-directed.
All right.
So you leave that company.
And we're not advocating for that.
Well, I mean, or you retire, or whatever. Yeah. I mean, people leave all the time, and and that's so. This is really a tool for people who have a 401k at a previous employer, whether they've rolled it over somewhere else or not. They can re-roll that over, or somebody who already is at 59 and a half, where they can now have access, full access to their retirement account, and they can now use that as a tool to invest in alternative assets. We talk about real estate because I think about 65% of my my old 401k now is invested in real estate. But you can do all sorts of other things too. I like the idea of investing in a business. So part of my
Startups.
IRA, my IRA, or another real estate partnership where, so my IRA owns a portion of this building here, the Woodworth building.
Yep.
So it allows you to do a lot of cool things that you otherwise wouldn't be able to do.
Pretty sweet, man. Pretty sweet. So we were going to talk about the ability to leverage on that.
Yeah.
So basically using a 401k self-directed IRA as a down payment.
Yep.
Towards a larger asset.
Yep.
What do you know about that? I don't want to put you on the spot.
So there's an UBIT tax when you do something like that. So when you borrow
What's
against
that
your
stand for?
401k,
You don't know?
unrelated business income tax.
Oh, there you go.
And I've not done it because I didn't fully understand it. I was kind of scared by it. And then as I've done more and more research, the next one I do, I will absolutely be doing this because you can use some leverage to buy more properties. So an UBIT tax occurs so let's say I want to buy a house with my IRA.
Yep. An investment house.
An investment property. Yep. So, you can't live in it. So I want to buy this rental property with my IRA. And let's just say for easy math, it's a $100,000 property. There'll be banks that will lend at 60 or 70% LTV. So I come out of my IRA with $30,000 or $40,000.
Right.
My IRA has a loan with this bank, and it pays back the debt at at whatever rate.
So would the bank have to be willing then to lend to an IRA?
Yes. So there's
So that's why you're saying 40% down.
Yeah, 30 to 40% down from what I found is the norm for it's
Right.
because it's a non-recourse loan, and that
Right.
means The only asset the bank can go after, if in the event of a foreclosure, is the property itself. It can't come after you for any other money.
Right.
It can't come out of your 401k. So there's limited amount of banks that do non-recourse loans. There's limited amount of banks that will lend to
Which
an
is
IRA.
higher risk for them, which is why they're requiring a higher down payment.
Higher risk, but like I mean, to me, is it though? I mean,
It's an excuse to get more money up front,
potentially,
and bolster their, pad their LTV.
Yeah, and for most people that are doing this in IRAs, it's 30 to 40% down is. It's not, that's not a huge
well,
obstacle.
No, you're allowing yourself in this case, like you said, if it's $35,000 off an IRA of money that you can't touch, you can't use, you can't spend, and now you're taking that $35,000 and converting it to $100,000 asset, where a tenant's going to end up paying the note for you. So you're building equity, you're getting cash flow that's going back into the IRA, like double whammy.
It's
Do you know, and I don't know if you know, but I'm asking, do you know how the depreciation works on something like that? Does the IRA get that depreciation, or do you personally?
So that's the one downside, and there's a lot of tax people that will say you shouldn't invest in real estate with your IRA because real estate already has so many tax advantages. You lose some of that with doing it with your IRA. But for me, it's more of a retirement vehicle to continue to grow my wealth, and it's more long term. I'm not going to be able to do that without it. So I'm not worried about the tax benefits right now. I may shift my strategy once I'm 59 and a half and I have access to that money and I'm actually pulling money out and that kind of stuff. But there are a lot of people who will tell you, like Tom Wheelwright, the
Wainwright.
Wheelwright.
Rich Dad.
Yeah, Rich Dad's tax guy. Like he's a big, he'll tell you like don't do it all day long, but you can invest in other real estate related items that don't have a tax benefit, such as mortgages, notes, things like that. You can. I think you said before, like you can
always find what
you're looking for.
Yep.
So I've found plenty of benefits for me to do it, and I'm seeing it, and I'm making good returns doing it. So you can find what you're looking for. So
if you're coming in like on this deal, you're coming in as a passive investor. You're not you're not controlling member. In this deal being the building we're sitting in right now, the depreciation factor isn't really what you're looking for.
No. Like you said, I mean, it's more about making an impact in my community.
Well, and we're getting, there's some grants associated with this. So the multiplier effect on the dollars here are pretty substantial long term.
And you're getting 7 apartments and, so on and so forth. So the reason why I want to use leverage going forward, because, you use that same example of the $100,000 property. And if I'm putting $30,000 or $40,000 down each time, I can now acquire 3 properties for the same amount of money as I would if I was paying cash for it.
Right.
So the UBIT tax comes into play when you sell the property. So if we bought it for $100,000 today, and let's say 2 years from now you owed, or you sold it for $120,000. The IRS looks at that as saying, okay, you wouldn't have been able to buy it without that money. If your LTV was 70%, so you got 30% of it was your own money, then 30% of the gains is all your gains, tax-free or tax-deferred. 70% of the gains, so in this case, a $100,000 property, we sold it for $120,000, 70% would be $14,000. You're going to pay taxes on that $14,000, which breaks down on that like size deal like $2,000. So it's not that big of a deal because again, now you've got your 12 plus
you're paying tax on profit.
You're paying tax on profit and only a percentage of the profit.
Right, a smaller percentage.
So that's where I'm like, okay, that's not as scary as I thought. There's no reason to be like slowed down by the potential fact of paying a small amount of taxes on profit by using some leverage.
But if you hold, you don't ever worry about that. Now, does a self-directed, can it participate in a 1031?
Good question. I don't think so, but I don't know. I've
never come across that. So
I don't know, but for me right now with what I'm doing, like I don't want to hold them. I want to try to flip them as much as I can because I'm having more fun doing the deal than I am.
Oh, episode 1, Deal Junkie.
So, but the side note is like a lot of the ways these deals are structured, the quicker I can get this real estate sold, the better my returns are.
Sure.
So and these are where my notes come into play. All that UBIT tax talk, like I wanted to didn't want to screw up the percentages. But I bought a
Nobody's
property.
listening anyway.
Yeah. Mom is.
Mom's listening.
She's
good.
talked
But
to me
mom
about-
won't fact check you.
Yeah, well, she'll
If you swear again,
correct.
you might not be able to come to Thanksgiving.
I learned my lesson. So, hey, Mom.
What's up, Dar?
Mean Darlene. See, now I'm in trouble again.
Yeah. Jeez.
I forgot where I was going with that, but like a deal I do. So if I bought a house for $100,000,
Yeah.
like I've done these a few different times. Now I'll resell it on land contract at a premium. So I bought it in cash
Through the self-directed.
Through the self-directed.
So that interest's coming in.
So, but
You're
then
like,
so I resell it at a premium. So let's say if same deal, $100,000 I bought it for, I resell it at a premium for 120 on land contract. So that's a 20% spread on year one.
Oh yeah.
Plus I'm getting 9%. So if they were to pay it off and after year one, that's a 29% return. Each year they keep it, my rate of return kind of diminishes
your
because
yield
that 20%,
drops.
that 20% starts getting averaged over 5 years.
now.
So a 29% return in year one, year 6, it's like a 13-14% rate of return.
So you look at it from this perspective, it's almost like being able to day trade day trade without tax consequence with stocks. Only you're playing with real estate, and it's obviously not day trading. It's year to year, month to month, whatever. But it gives you so much flexibility and an ability to have fun investing on what we would consider, and you should, safe investments that have upside, that have cash flow, to help really ramp up a retirement strategy. Because believe it or not, if you're working for a company and you're maxing out your 401k and you're getting a company match, you're probably not going to be a multimillionaire when you're done working just through that 401k. Whereas if you do end up having an event that transfers you from one job to another and you can roll it over into a self-directed, you could absolutely use that tool to make yourself a multimillionaire in a matter of 5 to 10 years.
Yeah.
So tremendous investment strategy tool that's out there that, we're seeing it right here in Owasso. There are projects that have happened in our own small little backyard because of this tool. And there's some big projects underway that guys that are investors are using it.
Yeah.
So definitely another way to just diversify your portfolio, diversify your retirement strategy with a little more control. And like you touched on a little bit earlier, talking to, because somebody's holding that 401k right now, whether that's Schwab, whether that's, local broker, whatever. And you may go and you may seek their advice. Now, they're not going to give you bad advice because they believe the best place for your money probably is in mutual funds, stocks, and the traditional stuff that you see 401k. They may tell you not to do that, right, Jim?
I just talked with a guy, an ex-Rocket guy too, last week, and I was telling him about this. Like, you got to find a niche. He's a mortgage guy too, and he owns his own brokerage. And I was telling him about the self-directed. He's like, I talked to my financial advisor. He didn't think it was a good idea.
Well, yeah, because if you pull it out, they don't get the fees off the money anymore.
Right.
So and we're sitting here from the perspective like, this is your money. We're not going to see any fees regardless, right?
Correct. Yeah.
We have no financial benefit in telling you to do this, other than what we're saying is we think this is a better tool for a lot of people.
Or it's a tool in addition to, because you don't have to do, if you're rolling over a 401k, you don't have to say, okay, it's all got to go there. It's something you can do in addition to. It doesn't have to be in replacement of. So you can still have your mutual funds and all that kind of stuff.
Let's say you got a couple $100,000 that you've gone from one job to another, whatever. You were there for several years. Like in your case, you were there 14 years. People leave. People transfer and things that happen. So you've got a good little chunk of money. You're calling it your nest egg, whatever. Well, let's take half of that. Keep it. You can still be self-directed, and you can direct it into a mutual fund. Your traditional stuff. But then let's see if you can take the other half and beat those returns. And you'll find you probably will. And then, I think that's kind of, you tipped your toes into it, didn't you? Or did you go all?
I tipped my toes into it. Like the first deal I did, it was such a safe. I still have it. I'm just like, can't wait to get it sold. You know, it's like, so yeah, I kind of tipped my toe into it. Like I transferred it all and just let it sit there for 3 months, kind of analysis paralysis. I didn't know what to do or how to do it. And then once I started doing it and realized how easy it was, it's like I can't. That's why I structure it in a way where the quicker it gets paid off, the better my return is. So I'm motivated to get it paid off quick so I can do it again.
Right.
Because I have a lot of fun doing it. And the side benefit is I just closed on a small debt consolidation loan for somebody, like a home equity loan type of deal for somebody last week. And he was very appreciative, so thankful. And once he realized that we didn't have bank loans that fit his situation, he was amazed that I was willing to do that for him. You know what I mean? It was, and it helped him out. It's going to save him a ton of money with how we structure the deal. So there's that aspect too. It's not just about me having fun. I can really, I really have the opportunity to help people. We talked about the land contract deals. That dude wasn't buying a house without somebody helping him out like this. So,
right.
And then for sure, I'm motivated as a mortgage guy to coach him through how to get his credit score up, what he should be doing from his 1099 jobs and how he should be managing certain things so we can refinance him out of it, try to save money with a traditional loan, and then pay me off as quickly as possible. It's a win-win-win, I freaking love it.
A multifaceted win.
It is.
Everybody's making money. Everybody's getting what they want. And then...
For the most part.
I
always want more.
Greedy bastard. Did I show you the coffee cup
I did,
Nick made
you
me?
showed me this. When you said Nick made it for you, I was thinking it was Nick Peidick, but Nick
from Dead Bread.
That's awesome.
Yeah, Nick, thank you, Nick. Nick made me a Woodworth commercial, Landlords Are Greedy Bastards coffee mug. It's my new favorite mug. Such an awesome deal. So with that, Jim, do you feel like you got it all out on self-directed IRAs? Because I don't want you to feel...
Yeah, I mean, I feel good now. We can move on to a different topic next week. But if anyone has any questions, feel free to reach out to me because I'd love to chat with you. Again,
I didn't get to say much here.
Well, hey, we'll see how the views happen on this. Maybe I'll host and you co-host next week.
Well, co-host means we both co-host.
Well, you're kind of the host, though. I mean, you are the guy.
I'm the man. All right. So with that, that's a great way to end. I'm the man. All right. Just kidding. But so that will wrap up this episode. Tune in next week. We'll talk about something else. Don't know what it is, but it's going to be awesome.
Yep.